Joining us now, China Beige Book CEO Leland Miller. Leland, we've been getting a lot of choppy data. I think about the consumer inflation data out of China earlier this week around this reopening and how it's taking shape. What are you seeing?
Well, the economy is a glass half full. And if you're looking at the quarter-on-quarter story, everything is better from the fourth quarter of last year. If you're looking at the year-on-year story, everything is worse. So you could make a case on bullishness or bearishness of the first quarter data, however you want. But I think the most important thing to do is to look forward to the second quarter. What are we going to see? Everyone thought that when the COVID Band-Aid was pulled off, there'd be a reopening of the economy. Yeah, it reopened, but the economy did not reactivate. What we're seeing now, you could see it in the February to March data improvement, is an economy that's starting to reactivate. We'll still TBD on the level of intensity of the improvement, but you're going to see a much better second quarter. And I think things are going to be improving, and that's what to focus on right now. The improvement already being seen in March and into April data.
Yeah, LVMH shares hitting a record high in the last 24 hours on the heels of those earnings, where the luxury company that owns so many different brands basically saying that they're seeing a big rebound in Chinese consumer appetite. Is the expectation that we're going to see a similar trajectory in terms of this reopening and what it's going to mean for demand for different products and then eventually services in China, that it's going to be similar to what we've seen in the U.S. and other places that were ahead of it?
No, I don't think so. I mean, the United States is a consumption engine. China is a savings engine. But if you look at simply what's happening, I think that you could just you can look at the trends. There may be some measure of a return to consumer spending. Travel will heat up. Some other things. But look, the dynamic here is you're going to have to see a stronger three months or so period of consumers returning to spending habits. Firms are getting going with investing and borrowing and hiring again. So you're going to see better numbers, particularly off a very, very low 2022. But this is not the United States. This is not a heavily subsidized household situation where consumers are just looking to spend their stimulus checks. It's much more restrained in China, and any consumption bump will be much shorter lived.
Yeah, that was sort of the read we got early in the reopening, right? Is that especially, say, youth unemployment, much higher than it is in this country, and that was going to lead to a delayed reaction function on the reopening. Do you think that's what's playing out right now?
Well, in part, but, back in December, when everyone got so excited about the reopening, he said, look, December and January and February have to play out because everybody's sick with COVID, and COVID zero, the structures have to be dismantled in order to get the economy going. You saw little bumps in things like travel, around the Lunar New Year, but January and February were never going to be big times for firms getting back into it on the hiring front. There weren't going to be consumer spending outside of some travel. So I think that, the expectation was that this bounce would come too early. We were always saying March at the earliest, probably April. That's starting to pan out in the data. We're going to have to see how intense the second quarter improvement is, but it's going to be a much improved second quarter. I think markets are actually a little bit too glum on China prospects for the second quarter.
Leland, how do you balance this against what are some geopolitical risks? And I think about Warren Buffett on our air yesterday saying that Berkshire sold out of its a majority of its Taiwan semi-stake, in part because of geopolitical tensions. Plus, you've got supply chains, Apple's in focus today, increasingly shifting out of China or diversifying away from China. How should an investor navigate that versus the tailwind of reopening?
Well, look, the tail end of reopening will create a cyclical bounce back. It'll still be within the context of a long-term structural slowdown. So you have to understand that any bounce you get, you could have an elevated growth for 2 to 4 quarters. It's going to be a bit of a head fake in 2023 in terms of China's future prospects. There is going to be much slower growth going forward. But when you're evaluating things, you have to be looking by sector. You have to be looking at where what the trajectory of specific companies are. The China growth story itself is going to be much weaker than people have understood in the past. But there are sectors that are particularly good opportunities. There are also ones that are becoming dangerous, like in technology. So the old way of China investing used to be just throw your money at China and they're ring-fenced consumer mode. Good things will happen with their tech companies. Good things will happen to their consumer brands. That's not the story anymore. You have to be much more specific in terms of your investment thesis in order to have it work in China right now.